Google's just changed the settings, but if there might be a fumble. And we're live with Eddie Chu for episode 13 of the Fair Go Basic Income Discussion Group. I'm Austin, and we're Basic Income Australia, or an extension of Basic Income Australia. Eddie, thank you very much for joining us.
Yeah, thanks for having me on, Austin. Today, I guess we're going to be talking about
inflation.
Yeah.
So we almost didn't have today's event because we didn't have one last year in December because we figured it's too close to Christmas and everyone's going to be busy and no one will show up. But we have got a lovely group here for you, and I thought it was really important because as we've moved into the second half of the year, heading towards Christmas, when everyone's doing their shopping, inflation's been in the headlines a lot. Now, I'm of the sort of in basic income circles, a lot of people, myself included, have made a lot of the fact that, well, look, inflation's low, so that implies that there's a lot of room for government spending. We're now seeing in the US, Biden inflation sort of come roaring back to life. And I remember that you were someone who in this sort of circle of people we've had on the show, like Alex and Jeff, of that circle, in which I would include you, you were one of the few people who was, even back when inflation was low, was like, don't be so sure about that. You were sort of more cautious and more alarmed about inflation than some of the rest of us were. So I guess, what were you aware of that we were missing? And what's your take on the inflation that we're seeing right now in the United States, and what that tells us for when we're thinking about a basic income?
We had actually a long and winding discussion a year ago with me, Austin, and Derek Van Gorder. So it's been very interesting. And I do want to get to that, but I want to start off with the foundation so that it all makes sense. So it all comes from this set of ideas that I've been developing for the last 2 years that I'm calling capital consumption theory. And one of the core dynamics of capital consumption theory is what I call the paradox of the worker consumer. So it can be compared to the paradox of thrift. If you guys are familiar with the paradox of thrift, wave your hand. I think most people are familiar. It's sort of Econ 101, but very briefly, the paradox of thrift was popularized by Keynes, and the idea is, if you imagine the economy as a group of agents, and then you imagine that they are all trying to save at the same time. Every time somebody in the economy tries to save money, they are going to reduce their expenditures. So that expenditure is somebody else's income. So as much as somebody tries to save, somebody else is going to actually lose money, income. And so if everybody in the economy tries to save at the same time, nobody can save. And the only thing that happens is that the economy shrinks, income shrinks, and production shrinks. That's the paradox of thrift. The paradox of the worker's consumer is a little bit similar, but we are adding the distinction that it is very important in the economy to distinguish between what's going on with the worker consumer, which is sort of like the bottom 80% of income earners, and what's going on with the wealthy capitalists, people who have lots of assets, and their assets earn a lot of money. And these two groups have different functions in the economy. So the capitalists generally are the owners of all of the capital in society, all of the companies, and through the companies, all of the factories, things like this. And the paradox of the worker consumer is the idea that if you split up the economy between the worker consumer and the capitalists, the owners of capital, the paradox of thrift looks a little bit different. And what it looks like is that there is a loop between the labor income going from companies to the worker, and then the worker then turns around and spends that income as a consumer to buy things from the companies who own the factories. So that is a spending loop. And the dynamic that capital consumption theory posits is that this is a positive feedback loop. It's a positive feedback loop. And so during a time period when, say, consumption spending goes down, or it's held down, that will actually reduce the aggregate demand in the economy, and that will reduce the demand for labor. And what happens when the demand for labor goes down is that will actually reduce labor income. So when labor income is reduced, then that again causes a reduction or a stagnation of consumer spending. And so this forms, if you imagine this occurring over a set time period, in every time period where one thing, spending, say, is stagnating, it will cause in the next period for labor income to also stagnate. And that will cause spending to stagnate again in the next time period. So you get a stable stagnation dynamic over a period of time. And I would argue that that is what is occurring from 1980 until the present era.
Well, but that's what's been happening since 1980 till now is the
Yes.
deflationary downslope, as it were,
Yeah.
as policy settings tilted a little bit in favor of the workers, against the workers rather, than a little bit in favor of the bosses, and then that sets off this chain reaction, this cycle of less aggregate demand, less demand for labor, lower wages, less aggregate demand. But has that turned around now? Is that what's happened? Is that's hit its limit and we're going back the other way? And it seems like we're going back very, very quickly, at least in the United States, with inflation jumping sort of, and it stayed higher than people thought it would.
Yeah. I think that it's not impossible, but generally speaking, I don't think we're there yet. And so briefly, the thing that gets us out of that cycle, because the last time we were at the, the end of this part of the cycle was around 1940, and you were getting the Great Depression, and you also had Weimar occur around that time. And what brings us out of it is progressive economic reforms, such as Social Security, such as the 40-hour working week. When you get enough income into the hands of the worker consumer, that cycle can turn around, and it is self-reinforcing both in the stagnation direction, and it's also self-reinforcing in the positive direction. And so from 1940 to 1980, after turning it around, the cycle actually continues to go upwards, sort of its own inertia and from the self-reinforcing effect. And that continues even to the point of reaching the limits of capacity in the 1970s. And that's why you get inflation, which creeps up during the 60s and then peaks in the 1970s. So if, if anybody has, questions about anything that I'm talking about or anything doesn't make sense, do feel free to, raise your hand and I'll try to make sure what I'm saying makes sense to everyone.
Everyone can put their hands up if they're like, Michael, I saw you, I wasn't sure, you had the applaud button before. Were you meaning to put your hand up, or was that meaning to be applause? You're muted.
It's a hand up.
Okay, so
hand up.
well, we've got a question from Michael, and then Stephen's next. So go ahead, Michael.
So Eddie, how do you see debt rising debt being factored in over that period, and the impact of extra borrowing?
That's a wonderful question. And Ray Dalio, and this group may be more familiar with Minsky, talks about this a lot, and talks about wealth cycles, debt cycles, big debt cycles from Ray Dalio. And I would argue that Ray Dalio basically has the outlines of the cycle correct. And he also looks at wealth inequality, which also, sort of rises from 40, goes down from 1940 to 1980, and then rises from then until now. And he actually attributes the debt cycle as being the main cause. And I would actually argue that the capital consumption imbalance is actually the root cause underlying those debt dynamics. And so, if the if what you're getting is that with inequality and more income concentrating at the top with capitalists, then those capitalists, have, end up with a lot of capital, which one of the functions of it is they will lend it out. And so you end up with sort of a surplus of financial capital, surplus of investment funds. And what that tends to do is actually to drive prices of debt down. It drives down the interest rate, and it encourages an expansion in the quantity of debt. So, when debt increases and you get more and more debt in society, um, some people will tend to like build a narrative around it as if like, society is being too profligate and spending too much money. And I would argue that you can tell that it is not driven by too much spending and too much demand for debt, so much as too much supply of funds. Because if you had a sort of a great increase in the demand for borrowing, that would potentially cause debt to increase. But the other effect of it, if you think about it in terms of supply and demand, is that a demand-driven increase would actually cause the interest rate to go up. And that is the opposite of what you see. What you see is the interest rates going further and further down, which suggests that it is not demand-driven, it is actually supply-driven. It's actually a savings glut. And another way to think about it is, with Jeff Crocker, argues that the debt is sort of making up for the lack of income. And I think that's also correct. So I think Stephen also had a question.
Yeah, let's go to Stephen.
Yeah, so what kinds of things are inflating in price? Like what do we mean when we say inflation? Like what costs more?
So I mean, the standard way to define inflation is the CPI, the consumer prices, and that is definitely what I think is most important. On the other hand, you have asset price inflation, which is a phenomenon, but maybe not quite as important to maybe the welfare of most people in society. But I think we'll get to that. So I think the next thing that I want to talk about is the automated factory paradox. So if we're thinking about capitalists and the rest of society, then the capitalists, they own the factory of the economy. And so Jeff Crocker and Alex Howlett all talk about this. And if you, Alan Watts, I think, talked about it earliest in his example. He draws an analogy. He says, you have this businessman and he creates a wonderful automated factory. He lays off all his workers, and then he turns around and finds that there's nobody to buy the products of his factory because they're all laid off and they don't have a job. And so that's the automated factory paradox. And it is, I think that is a very apt description of what is going on in the economy right now. But there is one nuance that we have to add here, because a lot of people will tend to think of this, and some people use this as an argument for UBI, but a lot of people tend to think of this in terms of black and white. And they say, oh, we're going to have all this productivity growth and nobody's going to have a job. You're going to have, massive unemployment and nobody's going to have a job. It's going to be a disaster. So that's sort of black and white thinking. And I would argue that you have to understand that the economy, the economic, the invisible hand, I guess, the supply and demand in the economy, they are adjustable. They will adjust to things like a surplus of labor. And so what I would argue that the result of productivity growth is not mass unemployment generally. It is actually what happens is that because labor demand is sort of going down relative to the economy, the natural reaction with the market price of labor, if you have no floor on it, is not that you'll have mass unemployment. It is that the wages, the price of the labor will actually continually be bid down. So this goes back to, why, there's sort of a puzzle. There's a popular chart from 1980 to now where the wages, were going up, and then 1980, they take a sharp right turn and they've stagnated for the last 40 years. And that is because of the automated factory paradox. Labor demand is being held down. which causes consumer demand to be held down, which causes labor demand to continue to be held down. So you have stable, stagnant wages for 40 years. Even as the economy grows, I think it's up 3 to 5 times since that time.
So wages should be 3 or 4 times higher than they are then.
Yeah, if wages had kept up with productivity growth, I've seen figures that they should be $25 an hour. And in the US, the minimum wage
as
is
a minimum wage, you mean, rather than an average wage? The minimum
as
should be
a
25, yeah.
a minimum, a minimum basic wage.
See, we've had better
So-
wage growth in Australia for some of that period, but it has started to it's been very sluggish and it's always fallen short of expectations.
Yep.
And wage growth is this sort of the something that that nobody sort of has an answer for
Yep.
in Australian politics. And in fact, when the government was planning its post-COVID response, part of it was betting on wages not rising much, right? And
Yeah.
it's this thing where so you've got cheap labor and you've got cheap credit, because what are the two? Because you need two. Those are the two things you need to invest and run a factory and start a business, and no one's doing that because there's not a market for the products. Is the basic picture.
Yeah, I think different parts of the world are sort of in different parts of this cycle. I would argue that Japan hit it early, but it borrowed demand from the rest of the world to stay in a relatively stable place. So I'd like to show everybody a little bit of data. So this is capacity utilization. It is put out by the St. Louis Fed. And what they do is they go around to factories, to lumber yards, oil wells, and they find as many companies as they can that have a pretty well-defined capacity, and then they ask the question, what is the maximum that this factory could produce, and how much is it actually producing? And it's generally going to be lower than the capacity, and it's generally going to be based on how much the factory can sell. So they'll produce as much as they can sell. If they can't sell it, then they won't produce it, and utilization will not be, as high as it can be. So we have a couple of features I want to point out about this chart. This capacity utilization from 1967 here to 2021. And one factor is that I want to point out, we talked about the paradox of thrift, and I think the paradox of thrift is very relevant. That is the relevant dynamic with recessions. So on this chart, the gray areas are recessions. We had one in 2020, in 2007, that's the GFC, 2000, that's the bursting of the tech bubble, 1990. And you can see quite clearly that basically in every recession, capacity utilization does indeed go way down. It drops very sharply in every recession. And that is sort of the paradox of thrift. People are not spending money, so factories are not as busy. So that is like a short-term effect. But I also want to point out a different feature was that if you look at the entirety of the chart from 1980 until now, the entire thing has a very, to me, a very clear long-term downtrend, and you are hitting sort of in 1967, you're near 90%, and then we sort of steadily trend down. We come up with every recession, but and we never come up as high as we used to be. So this is capacity
and the
utilization.
dips go lower.
And the dips go lower.
Go lower each time.
The dips go lower. Yeah. So this is capacity utilization. As far as I can tell, other economists have not even proffered an explanation for this. It seems to be something that is just generally ignored. But if you think about
there's also no mainstream explanation as to why interest rates and inflation have trended down for the last 30 years either.
Absolutely. And then, so if you think about the paradox of the worker consumer, and you think that because productivity growth is causing labor wages to stagnate, and so consumers don't have enough money to buy everything that's coming out of the factory, this is exactly what you would expect to see in the data. And it is actually the
Let's look at that 2008 and to 2010 recession there as well, right? And I remember hearing as we came out of it, everyone's saying, well, there's growth is back, but it's all been captured by the very wealthy, right? So the economic growth, when it came back, it didn't fire up the factories, and it didn't fire up all of the sort of the meaty part of the economy, right, because it was growth going into hedge into hedge funds and into people, economic activity at the top, which is sort of dollar heavy and content light.
Yep. So I'll talk about assets in a little bit when we look at interest rates, but I think the most accurate way to say this is that if you look at capacity utilization here, it does come up, but it does not break the long-term trend. So we do get out of the recession, but the long-term downward secular stagnation is still very much intact. That has to do with low labor wages and the inability of the consumer worker to really spend money.
And maybe at this point, you want to lay out the direct relevance to basic income, because to me and you, we've gone over it. I don't think we've actually pointed out that. So your basic suggestion is then that you fill this gap in terms of demand with the basic income.
Yep, you need UBI to give income directly to the consumer worker. If you do this, you can get the capacity utilization back up. And there's another effect with assets and the capital consumption imbalance. But I see a question from Bernice Takla. If Bernice, if you'd like to ask.
Thank you, Eddie. My question is, how much of the downward trend is, to your mind, allocated to decreased spending, and how much of it could be allocated to increased production capacity? So are we saying if the two are growing or reducing, I'm not sure, at the same rate, then yeah, I can see the concern here. But what if it's a case of the production capacity is increasing because technology is increasing so much? So whereas a factory used to produce 20 units 10 years ago, it can now produce 50. So how much of that kind of shift is captured in this graph?
Yep. That's a really great question. And the increase in capacity, generally speaking, is a good thing. The problem comes with, so the productivity growth is great, and the increase in capacity is great. But if you're a consumer worker, your bottom 80% or 90% of people are not able, they don't have the income to actually purchase as much as the economy can produce. First of all, you are sort of giving up production for no gain. You are leaving your factories idle a large part of the time, simply because of the lack of little green slips of paper, or they may be a different color in Australia, for the lack of slips of paper and in the hands of the consumer. And the other part is that the underutilization, let's see. The underutilization, because you are underutilizing both capital, and you also get asset bubbles, which we'll talk about in a bit, and you also get underutilization of labor. And so because of that low labor demand, labor wages are much lower than they could be, and labor is used in a much more inefficient way than it could be, because what happens is that even though you don't have as much labor demand, but everybody still needs to work to survive. So your supply is not going to be able to go down. And what happens is that businesses, as the wage, goes down or stays down, you finally get to a wage which is low enough for the business to say, okay, at this low wage, we will find something for you to do. But like it may not be a productive job, like being a cashier, something we could actually do with robots instead. But since labor is so cheap, we'll have you stand around and be a cashier all day, which is not the greatest job in the world. If you kept demand high enough and labor wages were high enough, you would incentivize the businesses to say that if wages cost $30 an hour, then we have to use this resource very sparingly. We have to pair it with a lot of capital, and we have to invest in that automation. And so the automation will actually be stagnate and not be invested, and not be created when you're not fully utilizing your economy, and when you're not, utilizing your labor and keeping it tight. The other part of it, because that leads into a good thing, is that asset bubbles are a result. So when the consumer does not have enough income, and it cannot, buy, the consumer can't buy all of the production, what happens is that when businesses go to invest in factories and do real investment into more capacity, they find that it is not profitable, because the consumer would not be able to buy all of the production of the new factory. And so the real investment, which is the thing that actually benefits society, actually gets frustrated. And that is the demand for capital. And so capital actually backs up as financial capital. You get increasing levels of stock buybacks from companies. Companies find that they can't invest the capital productively, so they just send it back to the shareholders. And then the shareholders, because they're capitalists, they already have all of their needs filled. Really, they're trying to invest the money, but if there's no way for it to be invested into factories, relatively speaking, what it does is it just blows up asset bubbles instead. It sends interest rates down. It causes stock prices, real estate prices, the price of gold, Bitcoin, GameStop, and AMC to just go through the roof. And that's not productive, as I think Austin was trying to say. I see a question from
before we get to Michael. I want to
and it sort of does that same beautiful shape. Peaks in 1980, and it's down from there, and it's upwards until 1980.
So I will go to Michael in just a second. What I was actually going to say was give the example of sign twirling, right? In terms of once labor gets cheap enough, you can put someone to stand on the side of the road and hold a sign. When literally, I mean, that's not, you don't need automation. You can have a post that can hold a sign up, right? But you got a living post. A human is and then you have this movie in this great movie, Sorry to Bother You, right? The girl is is working as a sign twirler, and then the hero is a unionist who's going to unionize the sign twirlers so that they can all get better wages as motherfucking sign twirlers, right? Because that's the best thing that it doesn't matter that they waste their life spending twirling signs if they get paid slightly more, but anyway.
Right. But Michael, if they were paid $30 an hour, the businesses would just not hire them, and they would do more interesting jobs, for $30 an hour instead. Go ahead, Michael, please.
Yeah. So Eddie, I agree that the capacity problem ultimately comes back to a lack of ability of people to signal their demand in the market. But on the causal side, I think there probably are many other factors too. The Reserve Bank, or the central bank in America, and other banks have moved from targeting unemployment to targeting inflation. There's also been a destruction of the labour union movement, and as well as technology increasing, as Bernice said, increasing capacity, and a lag where a company that has already invested, when there is either technology impacts or that could bring new people into the market, or even imports, then that technology that they already have, they're not just going to throw out the door. They'll just reduce their output and hang on to their capacity. So I think that over the last 40 years, there have been so many factors that are adding into this gap. But that ultimately the gap isn't utilised because people, as you say, don't have the money to signal their needs to absorb that gap. So it was more an observation and an agreement with you, Eddie.
Thank you. Thanks, Michael. Yeah, and
but let's get back to this question of inflation then. So what I mean, because my basic framework has always been inflation is the brake on a basic income, so that if you have if you start, I'm not a believer that governments need to worry too much about their fiscal position in terms of debt, but I am a believer that that they can run the economy too hot, and then spending becomes counterproductive because inflation eats away at the increased income. So does that mean the fact that there's inflation now in the US mean that if you were president, you wouldn't introduce a basic income, or you'd introduce it at a very low level? What does it mean, and why are we seeing it now if we've got these long-term deflationary trends?
If I were president, I would introduce it at as soon as possible at a relatively high level and pair it with reduction in interest rate and QE policy. But to understand where I'm coming from, I think that what you're talking about and the dominant paradigm of thinking about inflation is most people think that inflation comes from demand overwhelming supply. And so if you get on Twitter and publish and push your article around that says that UBI is the solution to hyperinflation, you will inevitably get some people who are coming a little bit from the the right side of the politics, and they will talk about this narrative about like Argentina or Venezuela, and how the narrative is that in those countries is taken over by socialists, and the socialist government just gave all this free money away and free services, and they just printed money and gave it to people. But because printing money does not increase the capacity in the economy, the narrative is that all that free money instead overwhelms the capacity, and you just get inflation. And so it is sort of like from that narrative, it's sort of like a big they figure it's a scam. Like the government's giving away free money, but it's not going to do anything good. So I'm going to argue against this viewpoint and say that that viewpoint is actually not correct. And the thing that we need to be really careful about when we're doing economics is that you have theories, and then you have to look at the evidence and see if the evidence, the data, agrees with your theories. And when it doesn't agree, then you have to revise your theories. So if we will think right now about this, that argument as a hypothesis, put yourselves in the shoes of that hypothesis and say, that's what we think. What would you imagine would happen with capacity utilization? You'd probably imagine that the socialist government comes in, print all that free money, and capacity utilization rapidly gets to 100% or whatever. And then after it gets to 100%, you have more and more inflation from there. And that's what you would sort of expect.
Or you would expect inflation would go up, and then once you hit 100% of capacity, then you'd hit hyperinflation, because there's just more, like, that's when it just becomes this insane thing where every day it's 100 times worse, because there's just no more space in the economy, and every dollar that someone tries to spend is already, the race car's already in the red. So, but that's not what happens.
Hypothesis completely. So that is exactly what the hypothesis says. Let's go and take a look at the data and see what the data says actually happened. So let me share this. So this is the inflation rate in Argentina. So in 2012 to 2014, it is relatively modest, for their country. And from 2014, it goes up, and sort of the long-term trend from 2014 is up and up and up. You get sort of it's a little bit volatile, but it's basically upwards from 2014, and it's now at 50%. So again, our hypothesis here is that around 2014, because of all that free money the government was giving away, you hit the limits of capacity. Free money does not make more products for people, and so you just get inflation after 2014. So that's what you expect. Capacity utilization goes up, hits the limit at 2014, and then it's just up there the whole time from there. So let me switch to capacity utilization and check if the data agrees with what we're saying. So this is the data, and remember, 2014 is the inflection point. So we expected capacity utilization to go sort of, go way up. And then from 2014, it is, maximum capacity. And that's why you have so much inflation. But, in fact, what the data says is that from 2014, from the moment inflation starts going up, capacity utilization is actually going down at the same time that inflation is going up. So it does not look like the free money is causing the factories to be completely, full output and unable to produce more. In fact, actually what happens is that capacity utilization just keeps going down even as inflation goes up. So how do we explain this? And this is actually recent. This is Austin, because we've talked about this before. I used to have a hypothesis about what I'm now calling type 2 inflation. So my prior idea about type 2 inflation was that, because of all the inflationary top of the economy, because of all that capital at the top, that drives movement out of the currency. That causes and then the currency goes down. But I used to think that, for instance, when the currency goes down, then foreigners are able to import lots of goods from the country. They're able to come as tourists and buy real estate, buy things cheaply. And I thought that you would actually get a stable spike in capacity utilization, and that would drive it. But I've found now that is actually not the case. Capacity utilization just goes down, down, down. So I've now revised my ideas about this.
So does that mean what you're saying, at least in Argentina here, is inflation is driven mainly by global currency markets rather than by the domestic economy?
That's sort of what I used to think, and I think there's some of that, but I've begun to think that there's actually something else going on here. And so let's see. Let me look at my notes so I make sure I keep this organized. So why would capacity utilization go down when inflation is coming up?
Or why would inflation go up when capacity utilization is going down?
As capacity utilization is going down? That's maybe a better question. And some of the stuff that has been going on recently has actually led me towards this thinking as well. For instance, earlier in the year, the prices of lumber spiked, and Joe Weisenthal on his podcast Odd Lots had an episode about how the lumber industry was a little bit reluctant to bring more capacity online, to do that investment into more capacity, because they'd been burned after 2007, and so they were reluctant to build more capacity. And I started thinking about that and thinking, that, if your prices are going up, but in a healthy economy, a higher price is going to incentivize companies to, bring in more supply because they can make, lots of profits with those higher prices. And that would be a healthy dynamic where high prices cause more quantity of supply, and the increase of quantity of supply would bring those prices back down. But what happens if you have high prices and, for whatever reason, such as because of demand uncertainty, for whatever reasons, supply quantities do not go up? Well, if supply quantities don't go up, then you do not have that downwards pressure on prices to keep the prices stable. And since then, I've connected it to another phenomenon of capital consumption imbalance. And I just want to make a note here. One thing about Argentina is that the narrative is that it's sort of, and a lot of these Latin American countries, the narrative is that they're very, very socialist country. But if you look at the data, it turns out that those same countries actually have some of the highest wealth inequality in the entire world. And so the right will tend to blame, the thing on socialism. But if you look at the data, these are really countries that are socialist in rhetoric only. And in terms of actually creating wealth inequality, they are not successfully socialist at all. They're actually some of the worst in the world in terms of inequality. And one of the dynamics that I've been thinking is that when you have a lot of inequality, and I think Alex talks about this a little bit also, you actually end up with a steeper aggregate demand curve. So if you think about what will tend to happen, you might think, is that if you have sort of this 10 or 20% that's doing really well, and they've got lots of money, and the top 5% is doing extremely well. And then the bottom 80% is, they're all struggling, and 70% of Americans cannot afford a $400 unexpected expense. So their income is completely strapped. You're going to, as that inequality increases, you're going to have an effect where the more the people who can afford the product can afford prices, higher prices on that product. And the people who cannot afford the product would not be able to afford the product even if prices stayed the same. And so, anecdotally in the last year, I've heard, Warren Buffett, Charlie Munger, and some other businessman that I can never remember his name, but there is, the talk in the industry is that businesses are finding that they have tons and tons of unused capacity, but they are discovering that because of this inflation narrative, and they're concerned about inflation, and then they raise prices, and they've been finding that when they raise the prices, their quantities do not go down, that they can sell almost as much at higher prices, which is really wonderful for their profits. And so they're starting to discover that it is really profitable to raise prices, because the people who can afford your product, they can afford it even at a higher price, and the people
so what's happening
who cannot afford your product wouldn't be able to afford it anyway. So it's no loss to you when you raise the prices.
So if we could crack open the headline inflation number, we'd see that it's actually, when goods are coming onto the market now, they're luxury goods. That if companies are investing, they're investing in serving the high end market, not their offerings are high end and not for ordinary people. Let's go to Stephen.
Yeah.
Sorry.
Thanks for waiting, Stephen.
Sorry to harp onto it, but doesn't it matter what specifically is inflating? So if the price of fruit and vegetables stays the same, the price of water stays the same, the price of electricity stays the same, but one thing just goes banana like nuts, like up 5,000%, then all of a sudden you're like, whoa, inflation. Whereas if
actually, I'm going to cut in there. I've seen some numbers that actually indicate that it's if you looked at what's inflating the most is food, rent, basics, and where you're seeing and that's actually being masked in the headline inflation numbers by electronics, and more and sort of secondary items, less vital items coming down in price. So I have seen numbers that indicate that so that people are buying organic cabbage for $12 or whatever, right? Might be part of that, or it might be that your shopping bill for your single mum with a daughter is going up dramatically.
And it's a complex picture, and every product and every category is going to be moving a little bit differently. But the big worry, and you know what, if Mercedes-Benz decides that they're going to triple their prices, who really cares? But the thing that we should really worry about is, if this is sort of a broad-based dynamic, and it's not just luxury goods, but ever more of even sort of regular goods start to see this dynamic where businesses are finding it's more profitable to just raise prices, and they do that. That is a negative. That's not a good thing, and that's sort of what you see in Argentina with lower capacity utilization. So let's go ahead to Michael, and then Emma. Michael, you first.
So Eddie, that's a very interesting observation. I'd like to add into it that the other aspects are things like bottlenecks, which can mean that every single firm is under capacity, though the whole supply chain actually is unable to meet supply as demand, and so prices do go up through bottlenecks. Expectations can also drive it, and also as inflation takes hold, then the currency falls, which means that import prices for complex inputs also goes up. So you have a problem where for a country like, say, Argentina, where they don't have a very complex economy and they're having to import a lot of their, not just their basic goods and services, but even their capital equipment. Again, that can drive inflation as well, even though capacity is down. So, yeah, I mean, it's a very, very complex interplay of factors, and I think, what you've said is a good insight.
Yeah, thank
Emma.
you.
I agree with Michael. I think that what I can see is that a lot of the evidence points to a few moving factors which are causing inflation, which isn't to do with the injection of money into the economy. However, if you're on a different side of the political spectrum, there's a lot of people talking about how definitely it's because of Biden's stimmy checks that is causing this this inflation. And I think, and because it's the biggest point, I guess, when politically you're getting into the nuts and bolts of the UBI, is there anything we can specifically point to that really kind of has the capacity to refute this in a succinct layman kind of way? I don't know.
Can I try, Eddie? Sorry. Eddie, I can see Eddie's going to go deep on it. I'll give you your soundbite. I'd say, well, why are interest rates so low? Is what I would say. That interest rates are low tells you that something else is up. Now you go, Eddie.
Okay.
So I do want to make super clear that blaming the inflation on the stimulus checks is 100% absolutely wrong. It is the exact wrong argument. And the checks, again, I have this article out called "The Solution to Type 2 Inflation Risk is UBI," and if you look at this data and you're convinced that the dynamics are working the way that I think they are, there are multiple. UBI is exactly what you need, and the lack of UBI is exactly why you're in this situation in the first place. And I will say that again, even a year ago, when I was talking to Austin and our other friends were not entirely convinced, I was already pointing out at that time that inflation is a risk here, and the reason is exactly because you don't have UBI and you have enormous inflation at the top, and right now it is asset inflation. But the thing is that asset inflation tends to eventually reach a peak, and it eventually reaches a point. And this happened in Weimar, Germany also, where you had the stocks and the equities just going absolutely crazy. They couldn't keep up with the paperwork because it was so much stock trading during their year of false prosperity. And eventually you get to a point where everybody says these assets are crazy. We've got to take our money out of that, and inflation tends to spike just as the asset prices start to crash. So it is, you should definitely read my article, but the whole reason you have the inflationary top is because of the lack of UBI. Because if you had UBI and the consumer could actually spend money, then businesses would be incentivized to actually invest in capital. And so that financial capital, those asset bubbles all that excess stagnant capital would actually be drained into real, productivity, into factories, into automation, things like that. That's exactly what you want. And if you don't have UBI, this is sort of the only way that things can be, which is off, and which does carry a risk of inflation. Yeah.
So I'm going to bring in a metaphor from left field here and see if we can switch it up a little bit. When there's a point at which someone taking a drug stops being a recreational user and starts being an addict, right? And I think the one way to define that point is once you're an addict, you're either too high or not high enough, right? Things are never really right ever again once you've crossed this threshold, and either you need more drugs or you've just taken too many, right? And what I would say is that the drug of our economy is credit. So in this case, everyone's like, well, we need more credit. Oh, there's too much credit. There's too much debt. Oh, wait, we need more. And the space for the central bank and the financial system to move gets sort of narrower and narrower, and now there's nowhere, right? Like they're out of road. If they raise interest rates, the world blows up. If they don't, the world blows up.
Yep. To build on that, that metaphor, the thing that you are stuck on is traditional stimulus, and the problem with it is that it's misdirected. It goes to the top of the economy instead of the bottom. So interest rate policy, lowering those interest rates, the biggest people who benefit from that are corporations, because they're the ones who are able to borrow enormous amounts out of debt markets at relatively low interest rates. So the interest rate policy, and then it also benefits a little bit assets. So it's all very top heavy stimulus, and you have an economy that is a misshapen economy, not enough income at the bottom, too much at the top. And this stimulus actually does not help. It helps a little bit. It helps in a trickle down way. And so a little bit of that, when you have this enormous wealth effect, you do have people maybe in the 50th percentile who have like a little bit of stocks, but 90% of the stocks are owned, at the very top. So what you do is you make these enormous asset bubbles, and they do hold up spending a little bit, but it's very inefficient, and it is very distortionary. And what you need to do is just to change the direction and the targeting of the stimulus, and instead of putting stimulus into the top, you have to redirect it to the bottom. And if you do that, then you fix everything. And if you don't do that, you get this effect where traders, financial people, they're convinced, and they're probably a little bit right that the Fed is afraid of letting the asset bubble go. And like you saw in 2019, you had sort of a big every time you just have this dynamic generally that every time the markets have a big crash, the Fed sort of seems to get scared, and they say, okay, I guess we're not tapering after all. And it is this place where if they reduce it, and I talk about this in the article, but it's like if they reduce the stimulus, the economy crashes. But if they don't reduce the stimulus, the bubbles just keep getting bigger, and ultimately it's not really sustainable.
So I was at a Labour Party, that's our Democrats, right? A Labour Party meeting about housing, and this guy who's meant to be really progressive from the Labour Party is sitting there sort of talking about how hard it is and how we can't do anything actually, because he says, well, you don't want to raise interest rates because that'll cause unemployment and that'll hurt our constituents. So shrug, I guess, we'll just have to keep doing nothing, right?
And everyone's at.
Yeah. But so what you're saying is, and this is not that dissimilar to what we've, other people in our sort of circles have been saying is, so, well, because you've got this other lever of the basic income, and you can increase, people's incomes and spending capacity with that, you don't have to be so worried about, pulling too hard and causing another Volcker shock.
Yeah, and it fixes the inflation risk. I've been wanting to say this because it takes that aggregate demand curve, which is too steep now, and is incentivizing businesses to raise prices because they can get more profits that way. And if you flatten it back out and you put money back in the hands of every single person in the economy, and they have money to spend, then suddenly those prices become more elastic again. Like, everyone has some money to spend, but they can't afford necessarily like very high prices. But if you keep your prices down a little bit, you'll get lots and lots of business, and you'll actually be able to run your factories at full capacity. So like, I understand that in Alaska every year when the Alaskan UBI checks come out, all the businesses have a sale and lower their prices because they all want to capture, that demand. And I would argue that is exactly what would happen economy-wide, is that, if everybody has money, then businesses will cater to everybody. And part of that is to keep prices down at a reasonable level. So yeah,
in the chat,
income down, you can have the markets actually crash. But if everybody has basic income, it doesn't matter. You can let it crash. And on the other hand, you're also going to have, with all that money, you're going to have more aggregate demand, you're going to have more revenues, you're going to have more stable earnings, which will help. And if the P, goes down to 15, it's fine. The wealthy will be fine. And if, regular people have basic income, they will also be fine.
So in the chat, Michael was asking about your article, and I put the link in, and I've also pulled up this paragraph in it, which is really, I think, cuts to the heart of why it's really important and why we're having this conversation now, just a few days before Christmas. He goes, in the context of the current one-dimensional paradigm, what do you do when problems close in from both sides? Reasons to worry about downside risk and reasons to worry about inflation risk, both increasing. Who's right? You can't both increase stimulus to prevent contraction and also decrease stimulus to prevent inflation, or can you? How do we resolve this dilemma? And I mean, the answer is basic income. Is that the spoiler there?
Yeah, that's wonderful, because you actually can increase stimulus to the bottom, to people who need it, and decrease it from the top where it's not needed and where it is creating all of these bad effects, including the risk of inflation.
So there's a lot of different theoretical disagreements that people have in this sort of emerging space, right? Sort of monetary basic income or macro basic income thinking, right? But one thing that comes back again and again is that you've got these two levers, and how you use them is this sort of a new counter-cyclical paradigm, right? So when the economy slows down, you push it up with basic income, and then when it gets too hot and you need to slow it down, when you need that, the interest rates are a good down lever, they're not a good up lever, right? And that's why we see the interest rate. The inflation goes down because we've got a way of pushing it down, but we don't have a good way of pushing it up, right?
So what I would like to see really is basic income used the same way Social Security was used to help us get out of the Great Depression. You should bring it up quite high. And I think that what that will do is it will bring capacity utilization back up to, much higher, 80 something percent. And my hypothesis is that when you do that, labor income will also go way up. So people will be better off because they have basic income and because wages will go up. And when wages go up, that will help them increase their spending, which will increase aggregate demand, which will actually cause wages to continue to go up, even if you do not continue to raise the basic income. So I think you should go way up. I think the measurement, the indicator and objective that you should look at is capacity utilization. You should get it up to 80 something percent and sort of keep it there. You should keep it there. If it starts to go down a little bit, you can raise the basic income a little bit. And then interest rate policy is fine for what it does, which is to just sort of get us out of those recessions a little bit faster. And it's fine when aggregate demand is down and nobody wants to spend, then you have a little extra room in the economy and you can lower interest rates and do a little bit more investment than you would have otherwise done in that particular time period instead of another period. So I see Bernice has had her hand up for a while, so let's hear Bernice's question and then Michael.
Thank you, Eddie. So I've been listening to the conversation around inflation, and I've been looking at what's been happening lately with all of the supply chain logistics things becoming more and more difficult. And I'm going, oh, that's going to have an effect on inflation, because inflation is not just the economy's ability to produce, it's also the economy's ability to get things around. And it got me thinking, what are the kinds of things that would break a UBI, that would make it that the UBI would be untenable, unworkable, make us go backwards rather than forwards. So I think the question that I have is something along the lines of pretending we not pretending, fingers crossed we put a UBI through, what would be the things we'd have to watch out for that might break the economy?
What are the risks of the UBI? That is a good question. I mean, to be honest, like I'm really, really bullish on a UBI, and I see
That makes two of us.
Yeah, yeah, positive effect. And the supply chain issues are, that's been a big narrative. And the whole thing is complicated.
There's a number of things that could happen, right? Like everyone could stop working in meat processing plants, and then there's a revolution because nobody's getting their pork or something, that could happen.
Yeah, so people not working, I don't think that is going to be a problem. So people not working, the thing is that, first of all, you're putting it in at probably $1,000. Like I've done a rough napkin calculation, and I think $1,000 would get us back to high capacity utilization, and it would be maybe like $1,000 comes in as basic income, and people also get like $1,000 more in terms of their labor income. So part of the thing.
$1,000 a month.
I'm sorry.
Sorry, when you're saying 1,000, you're meaning 1,000 a month in US dollars.
Yeah, 1,000 a month.
US.
Yeah,
yep, gotcha.
Yeah, around 1,000 or 1,300 a month. Like people not working, there is a solution to that, and the solution is wages. And I'm a believer in markets, just like many people are believers in markets. They work really well for a lot of things, and if you don't have enough of something, like say we're running out of oil or something, I, for one, don't believe that we will ever run out of oil, because there's a story 100 years back, all lighting used to be done using whale oil. And what happened is that they actually hunted the whale, almost to extinction. So the supplies were going down, they were going to run out, just like we're going to run out of oil here. And what happened is that the prices went up and up and up. And eventually somebody discovered that you can get oil out of rock. They called it rock oil, and they started turning that into kerosene and using kerosene to light the lamps instead, because whale oil was getting super expensive because you're running out of whales. And so the markets and the economy will find a way. If it gets scarce, prices go up, and the economy tends to find something else to
we're the
replace
whales in this analogy. Human beings are the whales, and the oil is our labor.
Exactly. So if people don't want to work, then what you have to do is, what will happen in the economy is that their wages will go up until they're high enough to get people to work. And the other thing that happens with wages going up and labor becoming very expensive is that suddenly automation and productivity growth begins to look very good. And the opposite is, the converse is also true, that if you're keeping wages way down, productivity growth is not going to be as profitable, and investment into automation is not as profitable. So if you make the labor scarce, bring the wages up, then businesses will find a way. I believe in businesses, absolutely. There are so many advancements in technology and in AI. The economy can produce things without needing very, very cheap labor.
Okay, so what I'm hearing you say is that one of the things that a UBI does is it brings stabilizers into the economy to bring it back into that healthy, let's not fall off a cliff kind of a thing, which acts as a buffer for the economy not to go down, I bet. This is what I'm saying. It's really badly worded. As I said, it's just an idea that I'm being floating around, but that's what I'm hearing you say.
I missed a word, so I didn't understand what you said. You said it brings something back into the economy?
Like stabilizing effects in systems. Whenever you have systems, you always got things that are stabilizers. What I'm hearing you say from your explanation is that what a UBI would do is that it would bring that stabilizing effect into the economy, such that hopefully we don't end up having the things like that would impact on it so negatively, such as the situation with the supply chain logistics.
Yeah, absolutely. Okay. I mean, that's exactly it. Like, when you asked the first question, like my mind went blank, because to me, really, the worries are like, if you don't have a UBI, I do see like, it's completely unsustainable. And it's not going to lead to good things. And then when you bring the UBI in, then you don't have to have all of those terrible effects. And so, I'm just completely like,
I was looking, I agree with you about
Yeah.
it's good in that it provides that comfort, that stability for people, and that can only be good for an economy. My concern was a little more around, well, that's all well and good if that's all well and good, but what happens if, despite all of that, the economy still shrinks and we are unable to produce, I don't know, crop failure, major crop failure, for example. There are things that we can, for all the technology that we have, we come up with doomsday scenarios.
Yeah, but I think it would be easier to do it if people are not struggling, and then you can turn around and invest into fixing those problems. I do want to take that prior thought a little bit farther and say that your wages go up, your productivity goes up, and eventually what happens is that you get to a point where wages are so high, and you also have basic income, that people get better and better off. And eventually they reach a point where they're sort of similar to people who are like financially independent, like they have enough assets that they actually don't have to work because they have income coming in. I think that eventually we can actually get all of society there, and it becomes simply not necessary. We have the same amount of labor per capita as we did 200 years ago, and the economy is like 100 times greater. We can have that continue, and we can actually push down on the labor needs. And the way it happens is that people start ending up with enough income that they say, you know what, I actually don't have to work, and if I don't have to work, I can be creative. I can come up with economic theories, even though I'm not being paid as an economist, or whatever floats your boat. That's sort of the utopia that is eventually possible with UBI. So I see Michael again.
So I've got a comment and a question, Eddie. In terms of the comment, I think a UBI is the first step of the solution, but for us to really create an equitable society, we're also going to have to shorten the work week and share the hours, so that we actually have a gradation of people who are on the UBI, some working for some time and so on, because otherwise we will still then end up with a tiny percent of people who are working, a tiny percent of people who own the capital, and a great bulk of people just living on the UBI. So that was really just a comment. My question is, if we are implementing a UBI and we reach capacity before we get to the poverty line, what do you believe should be done at that point?
So I think that so my calculations are that capacity utilization, as you saw in the chart, is around 70%, and if you bring it back to 85 to 88%, roughly speaking, you can afford $1,200 a month. So that's going to be huge. And the other thing is that there is a spending multiplier, that people go out, they spend this money, and they drive the demand at businesses way up, and then businesses are going to have to hire more. So labor demand goes up, wages go up, and then the poor also benefit from wages going up. So
I just I'll throw in one caution there, Eddie, in that wages won't ever actually fully compensate for poverty, simply because only 50% of the population at any time can work. So there's still, like in Australia, there's about 3 million, and I think in the US it's 50 million people who are actually living in poverty, and a great many of those people can't do paid work. So we're going to have to lift the UBI to that poverty line, regardless of what happens to capacity.
So
I want to get to Stephen, but I want to make sure that we're clear that Eddie's talking about, for anyone watching, Eddie's talking about US numbers. So capacity utilization in Australia is actually a little bit higher. And, we actually have less inflation, which is an interesting confirmation of like the US has lower capacity utilization than us and a higher inflation at the moment. We're the ones that have had a more generous welfare system than the US, probably historically. and we have the economy running hotter, but inflation is still
It's a
less
really
of an
good
issue
point.
here.
Yeah, so
Austin.
there are three things that I'd like to respond to Michael with. So one thing is that I absolutely support a shorter work week. I think that's wonderful, and it's necessary, and you do need to legislate it, because it's sort of, I think the work week is a little bit sticky if you don't legislate it. It just, it stays there, and it would be wonderful to reduce the work week, and that would make labor more scarce, and that would also increase the wages. And as you're speaking about, also distribute the work more evenly. The second thing is that I agree that there are people in society who may not be able to work ever. They may have a disability and they may never be able to work, and that does not make them not valuable people. And you should definitely support them, and you should definitely have, in addition to the UBI, you should also have, social welfare programs where if somebody has a disability and they cannot work, they should be supported, because society can afford to do that. The third thing is that if you want to raise the basic income to a poverty level, because you believe that is a good policy, and I would have to say I don't think that's a bad policy. I think that would be wonderful. But doing it would put you past capacity. There is a great way to prevent that, which is that you can introduce something like a value-added tax, and you can slant it towards luxury items. So, yes, if you need to take some of the capacity back from places that are not as important, such as like building super yachts and rockets and, and stuff like this, you should do that. So
And I'd
Stephen's
say
Let's get a
increasing
Stephen.
interest rates.
Let's get a Stephen.
Yeah.
Yeah, can you make a prediction about the price of goods and services with a UBI in place? Like, what do you think will happen to prices?
With the UBI in place.
Yeah.
So I actually think that right now, if you put a UBI in, I think that it would actually stabilize prices. I thought you were going to ask for a prediction about where prices are going to go right now, and I have to say that I am, I'm actually a trader and an investor, so I actually try to predict markets, and I cannot like be precise enough to say like this year inflation is what, next year inflation is what. But right now, I tend to think these macro ideas are actually fairly accurate, but they're very long-term ideas. So I don't know. So markets still have the space, like they can do that, like straight up thing. I sort of see us going towards false prosperity for a year, and then I sort of guess that inflation will go down, but then it will actually come back if we do not get UBI in. But I think if you put the UBI in, I think aggregate demand would go way up. You would see a little bit of what we've seen after the stimulus checks. Good things, aggregate demand up, economy growing very fast, wages would go up. There would be a little bit of inflationary pressure, so you may see prices going up a little bit, but it would be of the type which is not sort of destabilizing, because it is not that type 2 inflation type where it just cause the inflation just keeps going up. It's more of a if it's driven by actual demand, it will tend to be something which sort of readjusts the economy. One of the effects being that it would be readjusting the economy sort of away from labor intensive things, which if they're not sort of worth the labor, and more towards less labor intensive things, more automation. You saw that after 1940. So from 1940 to 1980, post World War II and post Great Depression, I think that's sort of what you would see. And you did have some sort of 1 year long spikes of inflation, but every time the inflation came back down, the most important thing is that real wages go up and up and up. Productivity growth goes up, and economists agree that was sort of the golden era. And the real wages are really what you actually care about. And the terrible thing about type 2 inflation is that the real wages actually get, they're sort of working against the current, because if prices keep rising, then it gets hard for the wages to actually keep up with the prices.
Yeah, I was thinking just one important one was like the price of medicine. Like that one's going to be a massive one in the future, and yeah.
Yes. I mean, healthcare is a whole other thing, and it's very dysfunctional in the US, and there's other countries where it works better. And so the US should definitely do what, say, Taiwan and other countries do, and say, and regulate those prices and have them more reasonable, because the profit motive does not, really, cause pharmaceutical companies to keep prices reasonable for medicines that people really, really need. I mean, the pure profit motivated thing is, if somebody really needs something, you can sort of charge as much as you want for it. And I don't think that's really what we want to happen as a society. So Michael. Michael.
Let's go to Michael.
What you were talking about before, Eddie, I was just thinking that it would be a really interesting comparison to look at Australia and the US around things like capacity utilization, the total amount of welfare, health spending per capita, minimum wages, inflation, interest rates, taxes, and wealth, per capita, because all of those things that we've been talking about, and Austin just made the point, when you reflect on the differences between the US and Australia, it almost makes your argument, because it really is a fact that we have got higher utilization. We've got at the moment lower inflation. We've got higher minimum wages. We've got higher spending on welfare and health. And interest rates aren't that much different. So but it would be good to see what that was as a trend line over the last 5 or 6 decades.
I think
we also
is that something? Is that data that you can put together, Eddie, or have you got your hand on that data, or Austin?
I don't have my hand on the data, but I do think it's interesting, if we're talking about the Australia and America, to look back at 2008. And how Australia sort of managed to avoid a lot of the sort of immediate consequences of the GFC. One, by the use of stimulus, right? Just giving people money was like the Labor government at the time was quick on the draw with the stimulus checks. Even back then, sort of got it. And at the same time, there was this big hit of interest rates dropping that I remember, everyone watching the news to see what the interest rate drop would be, and it went down a whole percentage point all in one go, and and that was enough to sort of to keep the Australian economy coasting right up until now, and we've had this, and so how did we get out of jail? And how did we get out of jail free card, Eddie, in 2008 Australia? Do you have a point of view on that?
I think what you were saying sounds reasonable, and I think again, definitely for the last 20 years, what the whole world has needed is basic income and more aggregate demand and a more bottom heavy economy.
So you would favor a global basic income over national basic incomes, if you could have.
I don't see those as exclusive options, but I would think that a global basic income would be incredible. And I think that, if you think about it, if you look at what China has managed to do, I don't think that all of the nations of the world, and many of them are much poorer as a nation than the US or the so-called developed economies. And I don't, from my perspective, I don't think that is some sort of immutable characteristic of that nation. I think that it's a bit of a catch-22. When nobody has income, then you can't spend, and the economy cannot grow. And I think that if you put in a world UBI and just gave people access to the economy, which the economy can afford, it would be incredible for the world economy. And I think you could actually raise the standards of living very quickly. I think probably you could be able to do the same thing that China has done in the last 20 years. And I think you could do it worldwide. That would be my guess about it.
Eddie, could I just chime in
Yeah.
there? If you can avoid corruption, I'd agree with you. But the other thing I was going to say, evidence of what you are promoting is also the Marshall Plan after the World War II, because at that time, America poured a huge amount of dollars, which were just paper, into Europe, which had its productive capacity destroyed. And where did those dollars get spent? Well, they got spent on American goods, which meant that the money just cycled around through Europe to boost the productive capacity in the States, who made a fortune out of supplying goods to Europe on money created in the US. And so if you just took that as one country, that's an exact example of what we're talking about.
Yeah. I'm a fan of monetary UBI, and in fact, I'm actually involved in a group called MADAO, which is the Mutual Aid DAO, and we are making a small-scale experiment where we actually do this, and we create a monetary UBI using a cryptocurrency out of thin air and offer it to everybody. And we're trying to build a well-utilized microeconomy by doing this. So I'm going to actually put that link into the chat. And then there is also another link that I've put into the chat, which is a brand new UBI economics Discord server that I've created. And I'd just like to welcome everybody who's interested in UBI economics onto that server. So 2 links in the chat.
I'm being asked what boxes have cars in them because I'm joining your group and it's checking that I'm human. Well, I mean, we're getting towards the end of our 90 minutes. If anyone has a very short question, now is your last chance to get it in. Any takers? Well, look, I think we can finish with, oh wait, Stephen does. Yep, Stephen.
I think, is inflation the big boogeyman for universal basic income? Is it the big scare tactic that people are going to throw at you?
Yeah, I mean, politically, yes, which is why I think this argument is very important for us to be able to tell people and show people why inflation is the boogeyman for not having a UBI. If you don't pass UBI, it really is definitely a risk. You're seeing Turkey. It's a worldwide phenomenon of capital consumption imbalance. Different countries are at different levels, but for example, you're seeing Turkey's currency is dropping very fast right now, and I actually think that potentially is sort of a canary in the coal mine, which is that you will have weaker currencies maybe encounter these effects first.
So we could have more inflation in 2022.
Or maybe 2023, yeah, unless we get UBI. So we really need UBI.
And on that note, that will bring this evening and our year of discussion groups to an end. Thanks everyone for participating. Thanks Eddie for coming today, and as a participant on a couple of occasions. He's popped in as well on some of our previous episodes just to hear our other speakers. I think one thing that's happened in 2021 has been that the basic income movement's definitely grown and matured and sort of solidified around the world. So that's something we can all be glad for. And I guess Merry Christmas and a Happy New Year, Eddie, and everybody else.
Thank you.
And
Merry Christmas,
same
everybody.
to you. And to Eddie, all the very best, and fantastic, interesting discussion. Thank you. And to everybody else, Merry Christmas, Happy New Year. See you next year. Bye-bye. Thanks very much, Austin, for organising it. Bye.
Thank you.